With markets so stretched at all-time highs, should we all be worried about a coming market collapse? The good news as active traders, we don't have to be worried about the downside. In fact, there are massive opportunities on the downside should this market start to roll over. I'm going to walk you through some tools that I'm using to help gauge when the timing is right to get more aggressive on the downside. So let's go ahead and jump in. Let's go ahead and take a look at XLF. This is the financial sector ETF. I love to trade the ETFs because they do give me instant diversification. They oftentimes have reasonably priced options. And when you take a look at some of the individual tech stocks, for example, after some of these extreme moves on the upside, the options are pretty expensive. I think there are other areas that you want to add to your list to make better use of your capital. Doesn't mean I don't like the tech stocks. I love them. But I also want to have exposure in other areas. Now, if I take a look at XLF, take a look at the right-hand side of my chart. Notice how I have some red dots popping up. This first series of red dots, that is my entry point on the downside. It's at 51.16. We have a very specific set of criteria that we look for on every trade that we take. When that criteria is met, we have the whole setup outlined for us. Entry point, targets, stop, it's all there in real time. That way, there's no guessing involved, right? I'm not looking at the chart of XLF and saying, well, should I take the trade? Should I not? It's either a setup or it's not. And if it's a setup, I know exactly where to get in and where to get out. I know that this setup, if it ends up hitting the entry point, it's going to have a very high success rate. We have seen win rates in the 70 to 75% range on these setups. So I know I can take it with a high level of confidence, knowing that that pattern has worked out in my favor long term. What it also does is it allows you to make those decisions off of range in the market. The entry, the targets, the stops, they're all there at specific price points geared towards that market condition, geared to the range that we've had, how active the markets have been. That way I can maximize my profit potential and limit my risk on every trade that I take based on current conditions, not based on what I hope the market's going to do. It's based off of what we're seeing in the current conditions. As market conditions change, as range expands, we can stretch it out and go for larger wins. As range contracts, we're going to go for smaller winners. That way we're committed to taking what the market is giving us on every trade that we take. So the nice part about this is we haven't hit the entry point. I still have time, plenty of time to get my order in place. As soon as price hits 51.16, it could be later on today, it could be tomorrow, next week. Doesn't matter. As soon as that entry point is hit, I don't go looking at financial media. I don't go looking at what the analysts are saying. I know it's time to put the trade on. At that point, I have my green light to get aggressive, put the position on. Now, if that entry point is hit, I'm going to take a look at buying a long put option. And here's why I get excited about that. Number one, it's going to leave me with a risk-defined trade. It's going to tie up very little capital, as you'll see in just a moment. And it's going to give me the potential for a really nice return in a very short amount of time. Again, I'm not expecting the market to crash. I don't need it to crash. I'm just looking for a healthy pullback on the downside. If I go over to the daily chart of SPY, look how stretched we are on the upside here. We've gone 9 weeks in a row on the S&P with positive returns, right? The market has been unbelievable. We are at some historic extremes price-wise, but notice what's happening here. Notice what's happened over the past few days. Are we up at the highs? Yes. But look at the sizes of these candles. We're starting to see smaller bodied candles. We're seeing more wicks pop up here. We're starting to see some tighter conditions pop up. Doesn't mean a reversal is immediate, but when I'm starting to take a look at my chart saying, hey, do I get bearish here? Do I start to lean into some bearish positions? I want to see more evidence of price confirming. We don't have it yet. We just took a look at XLF. The entry point hasn't been hit yet, but if I take a look at the market as a whole, we're definitely starting to see more tired signals pop up. We're seeing the big tech stocks doing all the heavy lifting. Under the hood, you're seeing more weakness in other areas. It's just been masked by the strength in tech. If we start to see things broaden out here a little bit, you start to see tech roll over, now all of a sudden, you've got something going very quickly on the downside. So when I start to see smaller body candles, more wicks pop up, we've seen some dojis here the last couple of days, that indicates a tired market. If I can start to see a pullback here, which we're starting to see off of the highs today, if we can break down through our 8-year EMA, that's right on the 744 level, everything opens up. on the downside. And here's why it gets exciting for the long puts, specifically on XLF. Look what's happened to volatility. Look at what's happened to the VIX. We have gone from up above 35 back in March to now we're down to 1675. It has fallen off a cliff. They have sucked all the fear out of this market. Why does that matter? As volatility contracts, the options get cheaper. As volatility expands, the options get more expensive quickly. With volatility contracting like it has, the long options that we could potentially look at on the downside are very, very cheap. On XLF, there's not a lot of volatility being pumped into those options. They're very reasonably priced. And if we start to see markets pull back, what's going to happen to volatility? Well, if we go back and take a look earlier in the year, we saw those spikes up. We saw those spikes up in volatility very quickly. The VIX can move very quickly off of extremes. In this case, we're starting to see an extreme pop up on the downside. If volatility expands, it's going to cause the put options to increase in value at a faster pace. It's like throwing gasoline on a fire. Right? When you start to throw gasoline on the fire, when you buy a long put option, the stock moves lower, the volatility increases, it can definitely lead to larger returns. That's why, as active traders, we don't want to be scared of the downside. We want to be active. Those are stretches where you can make up ground very, very quickly. So my bet here on VIX is that we're going to start to see equities roll over a bit in the near term. Again, I'm not talking about the high is in for the year and we're going to completely collapse. I'm saying over the next 2 to 20 days, my bet is that we're going to see equities pull back and we're going to see volatility increase. So what's the play on that? Well, if I go back over to the chart of XLF, I have this entry point at 51.16. If I see that entry point hit, here's how I could potentially put on the position. Let's go over to the trade page on XLF. Let's go out to the June monthly options. They have 22 days left to expiration. With a lot of these trades, the XLF chart is using a 130-minute time frame. It's more of a swing trading time frame. It's looking to capture moves over the next 2 to 20 days. By going out 20 to 40 days with the options that I'm going to trade, it gives me a little bit of a buffer there. Just in case the trade takes a little bit longer than expected, I have the ability to hold the trade without that theta or the time decay really hurting the position. So if I take a look at the June monthlies, and let's go out to the 52 puts. Why? They're slightly in the money, right? Remember, our entry point's down at 51.16. I need that entry point to be hit before I do anything. By going slightly in the money, I'm starting to stack the deck in my favor. The in the money options are going to be a little bit more expensive than the out of the money options, but I get a higher quality position. It's going to move quicker in reaction to stock price moving to the downside. The 52 puts, they're trading for right around $1.10. $110 per contract gives me control of the downside on XLF over the next 22 days. If the stock sells off, if the market starts to roll over, those put options are going to increase in value. If you add in the volatility expansion, like we talked about over on the VIX chart, now all of a sudden you can potentially be looking at a quick 50, 100% return or more, depending on how much volatility expands. So the reason I did this video, I'm seeing too many people talk about, hey, this market, we're close to a high, the market's going to fall apart, go to cash, get to the sidelines. I wholeheartedly disagree with that. As options traders, we have the benefit to make money in bullish and bearish markets. It doesn't matter to us. Take advantage of it. Look for those downside moves. They can be powerful, and you get the benefit of volatility expansion, which is not something you get on the upside. If you buy a call option, yes, there's money to be made on the upside, but you're not going to get the benefit of that volatility expansion like you get on the downside. That's why for me as a trader, my favorite conditions are those stretches where we do start to see equity sell off, volatility expand. There's just so much that you can do in that environment. If you're prepared, if you have some tools in place, I just walked you through, go out 20 to 40 days with your options, go slightly in the money when the trade hits the entry point, you're going to set yourself up for really nice returns, even in the midst of a market pullback. So if you'd like more information on how we approach trading long calls and long puts, especially in a market that starts to roll over on the downside, go ahead and click on the link in the description of the video. We'll get you some free resources. We'll get you an ebook that you can download, get more insight into how we structure our trades on a daily basis at NetPicks. If you have any questions on today's video, feel free to comment on the video, or you can email me, mike@netpicks.com. More than willing to help out with some questions there. So I'm going to wrap this video up here. I'll be back with you guys over the next few days with our next video.